We want to go into an in-depth concept, a very important concept in investment and finance, which is the market alpha. But before we go there, we've been discussing about the beta coefficients, that is an investment risk management factor. So particularly the security market line, which is this, which we had earlier touched on. So it's just a quick recap so that we'll be on the same page before we move on. This graph symbolizes the plots of the expected return against the beta coefficient, the risk factor of an investment. And here now is the region in which we have our risk-free rate. We have our risk-free rate here, and when we plot them together, we have the security market line. Usually is a visual expression of the two, and it always slopes upward from left to right, symbolizing the higher the risk, the higher the expected return. And beta factor is beta 1. When it's equal to 1, it means it's responsive, the stock is responding based in alignment with the market. But if it's greater than 1, when we have this region, we have it becomes aggressive and it becomes defensive in this region. But that is not where we are going. What now happen if we have a stock that actually outperforms the market? Don't forget that beta actually measures the performance of an investment against the market. But when we are talking about the market alpha, we are talking about a situation in which a particular stock or a particular manager of a portfolio actually outperform the market. So when the beta factor could be used to measure the volatility of an investment and compares it against the market. The alpha actually measures the performance relative to the market. So it's a very important concept. So a positive alpha indicates that investments actually outperform the market, and it has a symbol, while a negative alpha suggests that the investment underperform the market. So when a manager of a portfolio actually outperform, we will say the manager has beaten the market. And if the manager underperform, we will say that the manager has underperformed the market. So it's worth noting that alpha can be influenced by the various factors, including even the manager's skill. It could be influenced by market condition. It could be influenced also by investment strategy. So it's important to evaluate alpha in the context of all these factors before we decide whether we actually outperform the market or not. It could actually be calculated, and in the next video we are going to go into its calculation and how to calculate alpha. Don't forget that we know how to calculate the risk factor already and the expected factor, so the expected return, pardon me. So we are going to know how to now use this formula to calculate alpha. From GJAMES associate channel, Gbenga Olatunji FCA has been speaking. We are value to life. Don't forget to like, click subscription. We are value to your business.